What macroeconomic factors drive commodity prices? Imagine trying to predict the next big move in commodity prices without knowing what's happening in the world economy. It's like trying to read a map without any landmarks. Let's explore what really influences these prices from a broad economic perspective. First, supply and demand are the main drivers. When demand for commodities like oil or wheat suddenly jumps, prices tend to rise quickly. But supply often doesn't respond as fast because increasing production takes time. For example, planting new crops or drilling for oil can take months or years. So, if demand spikes suddenly, prices can become very volatile. Investors keep an eye on inventory reports and production data to spot these shifts early. Next, currency movements play a big role. Most commodities are priced in US dollars worldwide. When the dollar gets stronger, commodities become more expensive for buyers using other currencies. This can reduce demand outside the United States and push prices down. Conversely, if the dollar weakens, commodities tend to become cheaper globally, boosting demand. Traders often watch currency trends and may trade currencies of countries that depend heavily on exporting commodities, like Canada or Australia. Global economic activity also influences commodity prices. When the world economy is growing, industries like manufacturing and construction ramp up, increasing the need for metals, energy, and other raw materials. During economic slowdowns or recessions, demand drops and prices tend to fall across many commodities. This broad connection makes economic growth figures and global trade data key indicators for investors. Inflation is another factor. When prices rise generally, commodities often follow suit. Investors see commodities as a way to protect their money from inflation. When inflation is high, demand for commodities like gold or oil can increase, pushing prices higher. Geopolitical events can cause sudden price swings. Political unrest, conflicts, or trade disputes can disrupt supply chains or limit exports. For example, tensions in oil-producing regions often lead to fears of supply shortages, causing prices to spike. Governments can also influence prices through policies like tariffs, subsidies, or sanctions, which change production costs or demand patterns. Weather and natural events are especially impactful on agricultural commodities and energy. Droughts, floods, or hurricanes can damage crops or energy infrastructure, reducing supply and raising prices. For instance, a bad hurricane season in the Gulf of Mexico can cut oil production and cause prices to jump. Market speculation also influences prices. When traders bet on future price movements, they can push prices away from what supply and demand fundamentals suggest. This can lead to short-term price swings that don't always reflect actual supply or demand changes. For investors, understanding these macroeconomic factors helps in making smarter decisions. Watching economic indicators like gross domestic product growth, inflation rates, and currency trends can give clues about upcoming demand shifts. Keeping an eye on geopolitical news and weather forecasts helps anticipate supply disruptions. Timing production cycles, especially for agricultural and energy commodities, is also important because supply responses are often slow. Using currency trend analysis can help manage risks related to dollar fluctuations. By considering these macroeconomic factors in fundamental analysis, investors can better gauge where commodity prices are headed and make more informed trading choices.